Hey everyone, and welcome. Look, if you're a busy founder building a business, you already know there are about a million different things competing for your attention every single day. But today, we're going to focus on something absolutely crucial. It's the ultimate business safety net, yet it's probably the most misunderstood one out there: public liability insurance. My goal with this explainer is to totally demystify this whole topic for you. We'll be using actual data and guidelines straight from industry experts, and we're going to do it without wasting a single second of your time.
Okay, let's dive into this. We've got a really simple roadmap for today. First, what exactly is public liability? Second, how does it compare to professional indemnity? Third, do you actually need it? Fourth, we'll talk about the $10 million benchmark. And lastly, we'll look at how your coverage needs to change depending on what stage your business is at. All right, part one, what is public liability? So here is the stark reality of the situation. You spend years of sweat, tears, and sacrifice building a company, right? But literally one uninsured claim can wipe out absolutely everything you've built in an instant. It's terrifying. So what is this safety net? Well, at its core, public liability insurance protects your business against claims for injury or property damage that are made by a third party. And when we say third party, we just mean clients, visitors, the general public, basically anyone who isn't actually your employee. These claims usually come from your day-to-day business activities. But what's really important to note here is that it also includes products liability. That covers claims caused by the physical stuff your business makes, sells, or supplies.
Let's break down some real-world scenarios so you can visualize what this actually looks like. Say a client trips over a stray laptop cable in your office and breaks their wrist. Bodily injury coverage steps in. Or say you're at a meeting and you completely knock your coffee over a client's brand new, incredibly expensive laptop. I mean, we've all had that clumsy nightmare, right? Well, property damage is covered. It also covers court settlements and medical expenses for those injured third parties. But look closely at that legal defense part. This is absolutely crucial, because a disputed claim going through the court system can easily rack up tens of thousands of dollars in legal fees before a judge even makes a decision. Your policy covers those legal defense costs no matter what the outcome is, meaning even if you win the case, the legal costs alone could bankrupt you without this cover. Now, understanding what is excluded from a policy is just as important as knowing what's in it. And this brilliantly illustrates how other types of insurance step up to fill the gaps. Public liability does not cover damage to your own property or your own equipment. That's what business contents insurance is for. It doesn't cover your employees if they get hurt on the job. That falls strictly under workers' compensation. And crucially, it totally excludes your own professional errors or bad advice. Which leads us perfectly into Section 2, Public Liability versus Professional Indemnity. This right here is the number one question insurance brokers get asked. Assuming one covers the other is a really dangerous trap that leaves founders completely exposed. So think about your own business for a second. Are you physically interacting with people and spaces, or are you giving professional advice? Public liability covers the physical stuff, injury or property damage, like that classic example of the client tripping on a cable. Professional indemnity, on the flip side, covers financial loss caused by your advice or services. So if a client acts on a business strategy or design you provided, loses a ton of money, and blames you, that is professional indemnity territory. So you're probably wondering, do I need both? Well, if your business involves both physical interactions with clients and providing professional advice, yeah, the answer is almost always yes. Think of professions like physiotherapists, building consultants, or financial planners. They carry massive exposure on both the physical side and the professional advice side. All right, Section 3, let's find out if you actually need it. I want to challenge you to look at your own operations right now. Let's do a quick reality check. You almost certainly need public liability if clients ever visit your workspace or if you visit theirs. You need it for sure if you sell or supply physical products. Now, what's really interesting about this is the contractual side of things. It's a massive trigger. You're going to need it if your commercial lease or a client contract specifically demands a minimum liability cover. Actually, even if you just work from a laptop in a shared co-working space, those places almost always mandate that you have your own active policy. And hey, we've got to bust the biggest myth out there. But I just work from home. I don't need insurance. Look, working from your living room does not make you immune to liability. If you sell physical products from home, you absolutely still have products liability exposure. Keep in mind, those claims can pop up years after a product was actually sold. Plus, if you're operating as a sole trader, your personal assets, like your life savings, your house, your car, they can all be legally pursued if your business gets sued and can't pay. Moving on to Section 4, the $10 million benchmark.
Now that we know who actually needs this stuff, let's talk real numbers. We're going to answer the most practical question founders have. Exactly how much coverage do you buy? Well, here is the magic number in the Australian market, $10 million. So the crucial point is, this is the absolute minimum standard required by most commercial leases and basically all corporate client contracts. Before you pull the trigger on a policy, go check your lease agreements or client contracts. They usually explicitly state $10 million as the baseline. Now, you will see $5 million policies advertised all over the place, but this lower tier is really only suited for sole traders and micro businesses who have practically zero client interaction and absolutely no contracts dictating higher limits. Honestly, the most common mistake founders make is underinsuring just to save a few bucks on the premium. And then what happens? They land a massive key client contract that demands $10 million, and their $5 million policy is totally useless. Then, at the upper end, you've got policies of $20 million and beyond. This tier is for growing businesses working with government entities, dealing with huge corporate clients, or operating in high-risk industries like construction or large-scale events. All right, final stretch. Section 5, Coverage by Founder Stage. Let's move to a kind of blueprint so you can see how this builds and self-identify exactly where your business is at today. This usually breaks down into 3 phases: start smart, scale strong, and stay protected. In the start smart phase, so pre-launch all the way up to year 1, you're typically looking at that $5 to $10 million cover. This is for when you're taking face-to-face meetings, getting your first physical products out the door, and signing your first commercial lease. But here is a wild, incredibly surprising fact for this stage. If your startup imports goods to sell in Australia, the law literally treats you as the manufacturer, period. Even if you didn't physically make the product, you carry the exact same product's liability exposure as the factory overseas that did. So yeah, cover here is absolutely not optional. Next up is scale strong. This is a huge pivot point. You're growing, you're hiring, and your revenue pushes past that $1 million mark. Well, your risk exposure and your required coverage limits must inevitably scale up too. This is when you step up to $10 to $20 million in cover, especially as you start landing those bigger corporate clients, or maybe you start manufacturing your own goods. Finally, we have the stay protected stage for established businesses. Once you're here, the real danger isn't being completely uninsured. The danger is being improperly insured. If you change up your product lines or expand into international markets like the US or Canada, you need custom cover. Your business has almost definitely outgrown the original basic terms of your first policy. Over time, it's good to know what actually makes your premium go up or down. Basically, it scales with your revenue size, the physical risk level of what you actually do, and your past claims history. Having really strong, documented safety procedures can definitely help keep costs in check. But listen, I need to pass on a stern warning from the brokers themselves. Do not underestimate your revenue or downplay your activities on an application just to save cash. Doing that creates a massive disclosure problem, and it can literally void your entire claim when you finally need it. Which brings us to the ultimate question you have to ask yourself right now. Is your coverage actually keeping pace with your growing business? If your company looks fundamentally different today than it did a year ago, your policy might already be completely obsolete. Please, don't wait for a crisis to hit before you realize your safety net has a massive hole in it. Thank you so much for joining me for this explainer, and seriously, go check those policies.